For the Indian stock market, FY26 was a year that promised much but delivered very little. There were no sustained rallies, no decisive breakout highs. Instead, markets absorbed one shock after another. Foreign outflows, an AI-driven reset in IT, a tax hit from the budget, and escalating tensions in West Asia. The result was a market caught between brief optimism and repeated corrections. So how did Dalal Street actually perform in FY26? Let's break it down in this episode of Market Special. At the index level, FY26 looks largely flat. The Sensex declined 2.76%, while the Nifty 50 managed a marginal gain of around 0.9%. The Nifty Mid-Cap 150 rose about 6.6%, while the Nifty Small Cap 250 slipped 1.1%. Now compare that with FY25. The Sensex gained 5.1%, the Nifty rose 5.3%, and mid and small caps delivered stronger returns of 7.6% and 5.4% respectively. FY25 was a broad-based rally. FY26 was selective, uneven, and largely range-bound. 5 key factors shaped market behavior throughout the year. Foreign portfolio investors pulled out approximately 1.76 trillion rupees from Indian equities in FY26. That's one of the largest annual outflows in recent years. This persistent selling also pressured the Indian rupee, which weakened to a record low of 94.05 per dollar on 26th of March. However, domestic institutional investors provided strong support. DIIs invested 8.3 trillion rupees in equities, the highest annual buying on record, helping absorb foreign selling and stabilize markets. The IT sector saw a meaningful correction. The Nifty IT index declined 10 to 12% as concerns around deal pipelines and AI disruption led to a sector-wide re-rating. During peak volatility, stocks such as TCS, Infosys and Wipro fell by up to 6% in a single session. The union budget also weighed on markets. The hike in securities transaction tax on futures and options dampened derivatives activity, reduced liquidity particularly in mid and small caps, and added to broader market weakness. From late February, escalating Iran-Israel tensions pushed Brent crude to around $120 per barrel. This led to renewed FPI selling and sharp market corrections, with both the Sensex and Nifty falling 10 to 11% within weeks. Now, GST 2.2 provided a structural tailwind. Simplified tax slabs and rate cuts across consumer-facing categories supported demand, benefiting domestic and construction-linked sectors even as the broader market remained subdued. Despite the headline flat performance, sectoral divergence was clear. PSU banks outperformed, supported by improving asset quality, steady credit growth, and expectations of rate cuts. Banking, which accounts for roughly 25% of the Sensex, remained resilient. Domestic cyclicals, including autos, metals, infrastructure, power, and oil marketing companies, also held up. The market rotation was evident. Domestic-facing, CapEx-linked sectors performed, while export-oriented and AI-exposed IT stocks lagged. Now, the key question is whether FY27 brings back a broad-based rally or continues this pattern of selective performance and elevated volatility. Follow for more such market-related stories.